and welcome to the webinar where we take a closer look at the tools behind my stock scanner and the 3-point playbook. Using these tools, which we will teach you how to apply, our portfolio achieved an upside of 34.48 last year. In other words, we provide the tools, you make the money. Liam Flavelle, well met. Looking forward for having you here the next 60 minutes. I better ask straight off the bat, is there any questions you won't answer?
That's a really difficult one. I'm not going to mention anything about Adobe. I'm going to stay
Okay.
away from that. Adobe is dead to me.
Yeah, you killed that for us. Thank you so much. You and your partner, Hans-Henrik Nielsen, by the way, who has been in the market since 1987, you created my stock scanner and thereby also the 3-point playbook tools that we're going to take a look at. We are going to ask or answer a lot of questions tonight. We're going to focus a little bit on Scandinavian stocks. And to you who are thinking, why are they talking in this particular language? Well, we have a Danish webinar tomorrow for you at 7 o'clock tomorrow evening where Hans-Henrik Nielsen will be in. Hopefully his cough is getting pretty bad and that's why he's not here tonight, but he should be ready for tomorrow. Yeah, I
This
know
is
how
the
it is.
more interesting of the webinars, isn't it? You know, with
There you go.
hands is
Yeah, you defend that. That's good.
exactly.
Yeah, exactly. So FOMO at mystockscanner.com. That's the email. We have received plenty of emails, but you might get lucky or we'll save your questions for a rainy day or one of the coming shows. We will be doing these Q&As on a regular basis now. It'll be once a month where we'll have Q&As. So in that sense, don't worry if you don't get through to us this evening. We will try to do our best. And as always, we do strive for quality, upside, and timing. That's the three words that we put to every stock that we put on our daily show at 12 o'clock at noon in Danish and Tuesdays and Thursdays in English. Tonight's show, we look at Scandinavian stocks via your email sent to us. We're going to go to Finland, Sweden, and we're going to stay at the home market. We're going to be talking tires, cleanings, and dimmers. How about that for a teaser? We'll
Wow.
also discuss the stop loss, mining stocks like Glencore and Rio Tinto. And remember, the mailbox is open. But Liam, let's start with something very, very on front and center of all the news because AI jitters all over the market. And we had a question in regards to a stock that, well, we talked about it on the show today, and we will also use it to show you a little bit about stop loss in that sense that one thing is that you get into the stock, but how do you get out of it? Micron, what are we looking at here, Liam?
Yeah, Micron is an interesting stock. It's let me just share my screen very quickly. Let's just get us into the right place and there. Yeah, Micron's an interesting one. We talked about it earlier on. It's a stock we were in. We made, what was it, 40%, something like that, I think, officially on the playbook on it in about 6 weeks, something like that. What's happened in the AI industry is that the technology that's being used there, the NVIDIA and the AMD chips and things like that, are all starting to use massive amounts of memory. And there are only three major memory companies in the world: Micron, Samsung, and SK Hynix. We got into Micron just about the right time, so yeah, it was an interesting ride going up. What I'll just do a very quick 3-point playbook portfolio analysis on the stock. And then, once I've done that, then we'll fly through the others, and I'll just point out the pertinent points of this. But
Yeah.
the playbook, and it's one of the questions we've had as well, is can we just go through points 1 and especially point 2 of the playbook, because they basically say, is this a quality company, is question 1, and is the company actually undervalued? Because we only want to buy cheap stocks. We want to buy really good cheap stocks that are ready to go up. That's the basis. This isn't rocket science. What is the clever bit that we've done is we're trying to quantify everything, so it makes it simple for you guys to see whether something is of good quality, whether it's of high, whether it's undervalued or overvalued, and also whether it's the right time to buy. And it's pretty simple with Micron because you just look at all the green on the page. You almost see sunglasses from it. So this is our playbook page. I've searched for Micron and I've come to the initial page on here, which is our playbook summary and dashboard. And the question 1 really gives us a load of data on the pertinent points that we have identified that make a company a quality one. Initially, we have a quality score. That is made up of a number of factors. We've had a late question in tonight, which we're not going to be able to get to, of what these scores are made of. I'll write an article in the next few days to cover all the sort of different variations and information that we use in there. But the quality score is a key thing we look at. We also have a value score, and we have a momentum score, and we have an overall stock score. But the one we use day in, day out is this quality score. And that just tells us, out of 100, where does this company sit in the whole of the country the company's in. So in this case,
And one of the things I'll say right away is that, of course, you have the overall score you just pointed out, or the score of the quality of 92. But we are not afraid if there's a red one in there. So of all the scores, we don't have to get to 100 on all of them.
no, I look for something over 60. Probably, yeah, 70 or above is pretty good. Sometimes we'll look at it and we'll say, actually, it's below 60 for a reason, therefore we'll ignore it. So one of the things it looks at is things like how volatile the earnings history has been over the last 6 years, 7 years, something like that. And the same with the revenue. So if the earnings per share is up and down all the time, but actually the company has fixed those issues or has grown out of those issues and is starting to grow strongly, we know that actually the quality score has probably been a bit penalised because of that. So we'll go into that. So as I say, I'll go through all of that and the score. But 92 is one of the key three metrics I look at when I look at the Playbook dashboard here. The second one is earnings per share. And this basically says, okay, in 2021, sorry, Micron was making $5.15 per share in profits out of there. Then it went up a bit, then it went down a bit. There was a big issue with oversupply in the market in 2023. And now, because of AI, everything has shot up. So in the future, this year, it's estimated to be $33 or $34 per share. And next year, it's suggested it'll go up to 43. So these are what the analysts think they're doing. And I don't know how many analysts cover Micron. It's probably 50 or 60, something like that. So it's the consensus number that they give us. So they think it's going to go great. From my own analysis of this market, and I keep on top of the tech market, so I can sort of talk about it and write articles about it. The memory supply issues are going to be there till the middle of next year at the very least. So we've got another year and a half of playing and of the stock price going up. So I probably expect those numbers to go up. So that's great. Earnings per share. It means the company is making money and it's going to carry on making more money in the future. That's what's expected. So that's music to my ears. So that's point two on this dashboard done. The third one is the peg ratio, and that basically tells us how much of the growth in earnings is built into the price. And anything under 2.5 is green and means it's really good. 0.11 means it's exceptionally good, and it's something that we should look at. So those are the 3 points, and I'll go over this again and again during the webinar. Those are the key three areas that I look at that tells me whether I want to waste any more time looking at a stock or not. And we'll definitely see that in some of the stocks we picked tonight, and you guys suggested. There are reasons why you can identify immediately in the dashboard that actually I'm not going to waste my time with this. There are hundreds of other stocks that are better than that. If we go on, everything else is green. You've got revenues going in the same direction as earnings. You've got the analysts love it because it's got a score of 4.5 out of 5, which is great. The analysts have moved their EPS percentage that they think is going to happen by about 103%. So they've doubled their earnings estimates in the last quarter. Return on capital, return on equity, return on invested capital are great. They're basically measures of how efficiently a company turns $1 of investment into earnings at the end of it. They're great. They're a bit up and down here, but they're a good level. Free cash flow is the other thing. Free cash flow is always important because that's actually how much cash a company actually generates, and that's taken from the bank statement. I always go on about accountants sort of trying to screw everyone over and fudge the numbers all the time. That is pretty much because my wife is an accountant, so I like to sort of get one over her as much as possible. But and she doesn't hear it a lot of the time. But actually, the free cash flow is something that we watch a lot, simply because you can't fudge the numbers. With earnings per share, there are always ways of bringing sort of revenue forward into a quarter so that your earnings are inflated. So you can mess around with those numbers. With free cash flow, it's a lot more difficult to do. And lastly, the last three down here, you've got the price to free cash flow ratio, which we like to see below 35 or 40 or so. So it's just on the cusp there of being green, but it's everything else is fine. And we've got a couple of debt metrics that just tell us whether the company's in trouble or not. Current ratio is the current assets divided by current liabilities. It's a balance sheet term. It means they can pay off their liabilities, their loans, and all their outstanding debts if they need to, or the short-term debts. And interest coverage means that out of their earnings they can easily cover their interest payments. So
See, that was point one, and that was very thoroughly done. The thing is that you basically don't see, or you don't go through this. You pick almost three on a daily basis, and then you know right away.
the three tell me, so these three at the top tell me, is this something I'm interested in? And almost always we'll go on to the second point and start doing that because those three are in there. These other ones just tell us where some of the pain points might be. So here we can see that actually the free cash flow hasn't been all nice and easily come to the company. We'd prefer it to see it going up like that in line, like the earnings were. But they just give us some indications and some warning points to say, actually, there's something we might need to look at. But with Micron, it's absolutely fine. So I would move on to the valuations on here. Um, so the valuations, how do you work out whether something is cheap or not? We've got a really simple way of doing that, and that is basically we know down here what the last earnings were that the company reported, 7.6 in 2025. So these are all annual figures. The analysts, as we've said, expect 33.73 this year and 43.4 next year. Now, and they also expect a P ratio of 9. Now, 9 is someone like General Motors, a boring old motor company, probably trades around 6 to 8, something like that, because they don't grow particularly quickly. 9 is a really low number for a tech company that is in that everyone wants their products, and there just aren't going to be enough of their products to sell over the next 2 years or so, 18 months. So what I've done is I've gone in and looked at the history and said, okay, these numbers for the PE ratio are 21, 17, and 14, 15. So what this does, we set out three cases. We basically say we've got a bull case where if the company hits their corporate strategy out of the park, they absolutely nail everything, and they everyone loves them, then they might hit 21 on the PE, because this is about investor appetite, investor risk, how much they're going to take to buy into your company. In the worst case scenario, where will that stock trade? And we put it at 15 here. And then actually what we expect to happen is 17 and a half. So we tend to look at these two figures. And the way we come to that, you don't necessarily need to work it out, how these numbers and put them in scientifically into the system, though you can. What we do is we move these lines so that they match the history of the company going out there. So if I just drop down the number of years that we're showing here, we can see that over the years, the red line is it's actually quite difficult to see because it's so close. We'll have better examples as we go forward. But the red line has been in the last year or so where Micron has bounced. So that's the worst case scenario. That's the point where investors have said, okay, we've taken a lot of pain, but we're going to go back into the stock now. So that's where it's bounced. So that's what I'm saying is the lowest point that the stock is probably going to get to if the crap hits the fan, as it were. And you can see here it actually bounced there in November and then went straight up. We bought around here, I think it was. Similarly, on the green side, the bull case scenario, I just drag this up so it matches the peaks over the last few years of where the stock has topped out and investors started getting out of it and started selling, because that's probably where they're going to start thinking the same thing. We see loads of examples where it carries on going up, and it means it's really, really overpriced. But we also see a lot of examples where these bounce and then come back down. So that's our absolute target of where we want to go to. And then somewhere in the middle between the two, we put our base case. And we very simply look at this and say, is this half what this is? And yeah, that's the basic rule of thumb. We're trying to load the dice in our favor. If you take the casino analogy, that we're if we lose, okay, we lose some money, but if we win twice as much. So that's where we land, and that's one of the key elements of why we were so successful in the market, because we look at the risk factors involved as well in here. So here you can see very simply, just by matching up the history, we think the worst case scenario is that the bear case is 57% by the end of next year if we just hold, and the worst happens. Best case would be 130% gain. The analysts say 5.4% loss. To be honest, we'll take a 5.4% loss if we've got the option of making 83% out there. So
Again,
to me,
that's loading the dice that you're
that's
talking
loading the
here.
dice.
Yeah.
So that chart tells me that yes, this company is significantly undervalued. There's significant upside, and it's a tick in the box for question two.
And then we
Lot.
get to question three. That's the timing of it.
Yes. And the timing of it here, really, we've got three or four key areas that we look at. So the very first one, we've got a couple of indicators down the bottom. They're both actually the same indicator. One is from a daily series and one is from a weekly series. It's called the MTI. It's what we call our momentum trend index. And that basically gives us a green or a red. It's really, really simple. There's quite a few sort of mechanics behind the scenes, but it basically tells us whether the stock is in a good, strong trend or not, on a daily basis or on a weekly basis. And you can see Micron had a wobble on the daily basis down here and over here as well. And you can see the dips coming in there. It's not necessarily predictive. It more tells us the strength of the trend in there. But the weekly is intact here. We also use generally two moving averages. We actually used another one last week when we exited Micron, but we tend to use the 50-day moving average, which is this green line here. If I just come in, you can see the stock has bounced on the green, there, pretty much there. It's dipped below it, then gone up here and here, and then dipped below it and then gone up here. So it's using, sorry, that's the red ones. It's using these trend lines to say, okay, there's support. They hit those trend lines and then they bounce up again. The Micron's been using the red 20-day much more than the greens, so it's in a really strong trend. And the black one down here is the 200-day. If a stock drops below the 50-day, we tend to sell if it meaningfully drops through there. But in this case, last week, we had a drop. We had a gap here, which is basically a difference between the very lowest point on the previous day and the opening point of the next day. A gap down we've found historically, tends to be a bad thing for a stock. Not always, nothing's 100%, but it tends to be a bad thing. It bounced a bit off the 20-day and then started going down again. And it was at that point that I was away last week, but Hans sort of looked at it and you looked at it and said, there is so much distance between here and the bottom, 15%. We don't want to give up that amount, so we'll just take our 40%, smile, and
Like,
go to the bank with it.
and exactly, and that's also because we know we can always get back in. We might miss a little jump of 2, 4, five
Yeah,
percent, who knows? But the jump compared to, again, we're trying to stack the dice. So also on the loss, if we see a loss, let's get out of it. We always exit quicker in that sense that when we see losses,
yeah.
we don't have a big drawdown.
Completely, and that's exactly why. So we almost certainly will go into Micron, I think, because we've just done a 3-point playbook analysis. Everything ticks the box. Everything's green. I'm sure we will go in at the appropriate point, but and our subscribers will know when that is.
and we have a lot of stocks to get through because you guys have been writing us, especially about Scandinavian stocks. We have those coming up. We're going to Finland to look at tires. We're going to Sweden to look at light dimmers, and we're going to come to Denmark and talk about cleaning. ISS is going to come up. Before we get that, we're going to speed things up because now you're talking about upside, but there's also those who have been beaten down and might hold an upside over time. Let's bring up this one because people want to know about Microsoft. Has it bottomed out, in your opinion, Liam? Are we at the very bottom for Microsoft? Because it's a rock solid company, isn't it?
Okay, we get asked that question a lot, and the answer is always we have absolutely no idea. We just have our rules and we follow them, and we make money. So we're not interested in picking the bottoms of stocks, and we're not interested in picking the top. So we will never buy at the bottom, and we'll never sell at the top. Once you accept that, it's quite enlightening because you're not trying that anymore. So that's great. What I can do is just analyze the stock very quickly. You can see from what we were talking about just now, quality
You need
score
to,
98.
yeah, you need to
Oh,
share your
and I
screen. Just to,
show you, oh,
you're
you
on a different computer. That's when you have 18 different screens. You have a lot to pick from.
I know. Um, we can see here the quality is 98. Earnings per share is going up, though less so the following year. It's only 10% up the following year, and the PEG ratio is below 2.5. So I'm immediately interested. Everything else is pretty much green. Analysts love them. Revenue's going up. Some of the returns are dipping down a bit, so they're in the red, but actually they're not too bad. And we know one of the reasons why Microsoft is in the doldrums at the moment is because people are saying, yeah, excuse me, out of the hundreds of billions of dollars you're spending, when are you actually going to make a profit out of AI? Which I haven't had a good answer for yet, though we've been having some good discussions in ActiSnack and various places today about it. We can also see price free cash flow is in a good place. Free cash flow itself is in a good place. So yeah, Microsoft is a strong contender. We know it's a quality company. Is it undervalued? Yeah, according to this. You can see here, I've mapped the red. I've moved it just down so that it fits onto, the bottom where we are now. It could be bounced. I haven't actually looked at what it's doing today, but it also pretty much mirrors the bounces back here in 22, back here in 2020, back here in 2019. So that's not a bad place to put our bear case scenario in. On the green side of things, on the bull case, I've matched it to the peaks over the last few years as well. So that seems pretty sensible. And I've pretty much mapped, I've just gone below the analysts actually. The analysts think that the stock's got 48% up. I've said 40. We're basically, it's sort of a win-win scenario according to the value chart here. Could it carry on going down? Absolutely. And probably will at some stage when the AI bubble bursts. But for now, it will bounce at some stage, I would guess, this year, because personally, I don't think the bubble is going to burst this year, just because there's so much money being poured into it. But, so that's something we'd be looking at if it bounces. And then question three is effectively, is now the right time to go in? And this is where you see a completely different picture. It's a fantastic company. It's undervalued at the moment, but it's a falling knife, and we don't try and catch falling knives. You can see here, totally different from Micron. You've got the MTI pair in red, so that tells us we're in a downtrend. We're not that interested. You can also see the stock is below the 20, the 50, and the 200-day moving average. We wouldn't be interested in it until it came up and went above at least the 50 and possibly the 200 as well. We have a new tool coming out in the next month or two called the stock map that allows us to take a peek on the momentum behind the industry and behind all the competitors that Microsoft have. So we're learning our way to moving, not ignoring the 200-day a little bit more and just using the 50, but we'll come into that in the next month or two.
But I would say in that sense that when it's stacked like that, that you have the 200, then the 50, and then the 20,
Yeah.
you better be careful. That is a falling knife. And at the
E-
same time, we don't hit them on top. We don't hit them at the bottom. That's how we
yeah.
that's how we roll.
And you can see here in an exact opposite to Micron, Microsoft dropped down below its averages around November time, and every time it's gone up to the 50 or the 20, it's hit there and been rejected down. So they're acting as resistance points, we now say, and we need to see a really good excuse for it to turn around and these becoming support points. So
Okay.
investors need to really believe in them.
Yeah. and it could be some ways away, but it could start tomorrow. Who knows?
Yeah.
We always, that's why we broadcast every day. We try to keep you informed each and every day. Let's clean house and let's do it with some Scandinavian stocks, because that's what we've been promising you over the last week, is that we're going to look at Scandinavian stocks in this program. We asked you which ones you wanted us to take a look at. And the first one, well, we stay at home. We're going to go to ISS and take a look at them. I know that you're a bit on playing on your away field here, Liam, but of course you have been around Hans-Henrik long enough, and me as well. So looking at ISS is almost like looking at an Irish company. I was pushing it. I was
It
pushing it. I could
could
feel it.
be. Yeah, no, not a proper company, but yeah, we'll go through it anyway. Um, we got the Playbook dashboard here, so I've just literally just gone into the search here, put in
And you need
the
to
ticker
share
or the
that
name.
screen as well.
I'm not used to doing the show on this computer.
Yeah.
There we are. So I've literally just hit the search button up here, search for ISS, and it's actually in this case come up the top because that's the ticker symbol. And we come straight into the dashboard. We get some information on what the company actually does and where it operates. But really the things we're interested in is the key information. Quality score 87, earnings per share relatively flat actually, but I think the graph is lying a bit because we got such a loss here. PEG ratio below 1, so that's fantastic. Analysts love them because they've gone up in the last 7 days, 30 and 90. The returns are great. The free cash flow is great. Everything is a tick in the box there. So, yeah, a really, really high quality company. What's not to like? What's not to like is actually the value chart. It's overvalued, or priced maybe for perfection, or just priced at the top of its range. What we're looking at here is effectively saying, okay, in the past, investors have been willing to come up to this level, which is a PE of around 45, something like that. Sorry, 14. Um, and they've been willing to sell at about 13, something like that down here. So that's where the red line is. That's where I put the green line. I put the blue line right in the middle. So we're effectively saying if these are matched, if we're right, in the perfect world, we might see a 10% return. In a real dire situation, we'd actually lose 31% on this, and actually we probably think it's going to be 14%. So that would be one that I would say no, not interested. I'm not. I wouldn't even bother to look at the chart.
And because we're not looking at the chart, I can see the analyst thinks minus 100. That's not
Okay,
true.
that is a feature, we're going to call it.
Yeah.
You can call it a bug, and you probably have in the past. It's we need to get rid of that because basically what is happening is the analysts aren't supplying a target price for ISS. Therefore, we can't calculate that terminal PE value in a couple of years, and that's why the system's thrown out. We need to hide that. We've got that on our list to do. So if
Yeah,
it's
but
minus
it's just
100, it doesn't mean they think it's
no,
going to drop to
no,
zero.
no.
It means that we haven't got the data to paint the analyst's thoughts and processes in.
Super quick on ISS, and then we move on. Let's spin some wheels here, because let's go to Finland. I feel like I'm part of the Eurovision all of a sudden, because we're going to Finland and get the Finnish jury in, but we're
You're not
not.
going to
We're
sing, are you?
no, I'm not going to sing it,
Okay,
especially
just
not in
checking. Thank
Finnish.
God for
So don't worry, don't worry.
that.
Nokian tires. I'm not going to say what they're called in Nokian Rankat or something like. I tried. Come on.
We're still
Um,
doing accents, are we?
no, no, we're
No.
not.
Okay, right.
But Finnish tires for sure. It's one of those that got out of left field for us, and somebody asked, "Can you take a look at them and tell us what you think?" We're in some of the things that we really like, because we like basic things sometimes, because it seems like to be a very steady thing, a grinder. It goes slow and easy, and it goes uphill.
Yeah.
But what about the Finnish version here?
Well, the finished version, I think when I go on to the playbook page, and I remember to change the page properly on this one, everyone's going to know immediately. Actually, we're not really sure about this one. You look at this, the quality score is 22. The earnings, the company's had a dire last 4 years, and it's starting to show some progress on earnings there. So that's almost certainly why the quality score is quite low, because it does look at that the volatility. It likes to see sort of just a nice easy progression upwards rather than this sort of show here that we've got. Revenues are similar. They dipped down and then came back up, and that's another thing that will take a hit on the quality score. The health score, which is an interesting one, is called the Petrosky F scores, after a guy called Joseph Petrosky, who's an accountant that came up with the health score for these things, that's 2 out of 9, which is pretty poor. The analysts don't particularly like them over the last week or so, and the returns aren't great. So there's lots of red in there. To be honest, I probably wouldn't even bother to carry on with this one. But if we look at the valuation very quickly, you can see because the earnings have been underwater for the last few years, there's not actually a lot of recent history to base our decisions on. But what I did earlier on is I just put in, some lines here based on where the company has bounced over the past. It's down here, so I think maybe the company could lose 38% in the worst case. You might make 6%. Those are odds that we don't take.
And
As
again,
well.
if we look at the screen that you have right now, when there's no colors, it's because they're not making any money.
Yes, yeah. So that matches the this period over here where actually the company was underwater, and it basically says that we can't calculate the PE ratio because it's negative, so we just don't show it, so nothing comes through. So we've got that. The company has levitated for a while because people still see value and they still buy into the company saying, no, we're going to fix things. But it's not one that we'd be particularly interested in. Um, and you can see, from a technical point of view, from the point three, it's actually pretty good. And part of that is because people are starting to believe in the narrative. Part of it is obviously it's a tire company, so it bounces really easily.
Oh, that's a dad joke on a Tuesday.
It's
Let's
my
not have more.
first one. Huh?
Yeah, I know, but I know it's noted. It's noted. No more flat tires here. But again, this is a speculative stock that we're
Yep.
looking at here, because when they're not making any money or they're not making a lot, and still the stock goes up, it's because people have expectations, but at the same time, we're not getting into a stock
No,
like this.
no, we're not. You've got to realise investors have different timescales. We tend to buy our average period that we hold is around 70 days for the winners and around 20 days for the losers in the playbook. We can hold for longer than that. Some are about 120 days, something like that. So yeah, that's the kind of area that we play in. If people have got a 5-year horizon, they probably don't care about what moves in the next 3 to 6 months or so, as long as it's sort of sticking to what they thought was going to happen. So, some people will go into this and say, okay, I'm happy to buy now and just hold for a few years.
And that's also about strategy, and what we always talk about, your strategy can be different than ours, but stick to it all the time,
Yeah.
because that's the only way that you're going to make money, is sticking to your strategy and not change it every single day, for sure.
Exactly. And the core thing in this is you look at a stock every day and think, I know exactly why I'm in there and I know exactly what's going to get me out of it as well. That's what the playbook teaches us. And that's what any strategy should tell you.
Yeah. We're going to go for another Scandinavian stock, because you guys have really been active in our Tuesday poll from last week and suggested a lot of different stocks. And this one also came via an email from Brian. He said that he found Plight, which is a Swedish stock. He found it through a screener he created some time ago, and then he forgot that he had it. And he never heard about the stock before, but it looked strong, so I took a solid position. Afterward, I noticed the Norwegian oil fund also holds it in their portfolio. What do you guys think? Was I too quick to ask? We're never ever judging anybody, that's for sure. Right, Liam?
Each other, but no,
Yeah,
not anyone
absolutely.
out there that's important. No. So yeah, yeah, we won't go into those conversations,
No,
will
no,
we?
no, no.
Applied. I mean, on the face of it, Applied look, pretty interesting. Quality score of 95. The earnings per share is a joy to look at. I mean, that is just exactly what you want to see. And the PEG ratio being below 2.5 means that there is some growth still in there. So I expect to see a little bit on the valuation that comes out. Revenues are similarly sort of very, very pretty to look at. Um, Analysts have gone down a little bit in their estimation on it, but it's only a couple of percent, so it's not too bad. Returns are green, fantastic. Price to free cash flow, for the amount of cash that they produce, it's expensive. That's what that's telling me. But I can forgive that if everything else is right and the valuation's right. So, question one, tick in the box. We're absolutely sort of rocky and rolly on that one. When we look at the valuations chart, it's another pretty picture, actually. I think Brian got it absolutely spot on here. And actually, you might want to move this up. So I've matched the blue, the red, the bear case here with the bottoms in the market for the last, what, 3 years, 2 years. So that's the worst case scenario. You could it's up here. I know they're involved in the AI and the data center side of things and manufacturing, so some of the switch gear in there. So you could push that up for now, but I'll leave it there. Analysts think there's going to be a 13% increase, and that's based on a PE of 33. We think on average the investors have been willing at the worst case to pay 38. So actually we disagree with the analysts on that one. You could even say, well, in the past, investors have been willing to pay for that. Excuse me. I'm on my main screen here, so that's why some of these come up. So it has been willing to go up to there. So you could even push these up a little bit more. But I'd be more than happy to keep a conservative sort of number in there so that we can see, okay, that's the sort of number we're looking at. So easily our bear case and our base case match up. So that's really good. And from a trading point of view, the stock gapped up above its 50-day. We can see that here. Everything suddenly went green. Yeah, if Brian bought that within the last week or two, then he's onto a solid earner, and actually we may well copy him.
Yeah,
So
because in that sense, but it also to me, if I look back over the what you show on your screen right now, it looks like a sideways movement at the moment.
it does look like a sideways movement, and the one thing we often look at is these resistance points. So these get painted in by our we've got an automatic sort of painter of these support and resistance points, and you can see here that they basically map out where the stock has peaked and then not really gone anywhere after that. So it just collected its breath and then either went down or went up. So the greens are act as support, and they generally send the stock up when they get hit, and the reds act as resistance, so they generally send the stock down when they get hit and tested. We're very close to this resistance point, and one of the things we often say is that we we want a stock to do this. We want it to go up like this, bounce back down to maybe the 50 or the 200, and then bounce back up. And what that does is that confirms to us that that is now a support point and no longer a resistance point because it's bounced. And we would like the same thing really to be done on this resistance point here. We'd like it to go up above, come back and test it and turn that green, and then we know we're probably in a good momentum to go back up. So that's probably what we do right now. But if we were sitting here looking at this, we'd probably bought this maybe now. So yeah, or maybe we'd have waited for this to be broken. You don't know. It's one of those things that you need to see the news. You need to do a bit of research into the company and see what the reason for that major sort of gap up was. If we click on the earnings here, we can see that actually the company reported revenues under what they were expecting, but the surprise for the earnings was actually 15% higher than the analysts thought. So that was probably enough to gap it up, but it probably started making people think, okay, why were the sales that bad? And is that going to be repeated? So yeah, that's the sort of thing that could be impacting on the share price here.
And that's why, of course, one thing is doing technical analysis and looking at graphs and numbers and stuff like that, but you have to do your due diligence and find the news and stuff like that.
Yeah.
Don't react on the news on its own, match the things together. See, now we're talking about entering a stock. That's what people say, well, that's easy. Tell me when I need to get out of a stock. That's the hard one. We have questions in regards both to that, but also stop losses. Liam, the floor is yours because here I would look like a figure skater without the rehearsals.
Um, it's the exact opposite of the point three in the playbook. A lot of the time, we tend to look at a few things. So on the playbook, rarely, but it does happen. Some of these metrics change so badly that we think will come out of the stock. I can't remember it happening last year. Um, we can also look at the valuations, and if the stock is up here and it's really topping out, we tend to be on alert to sell the stock. So thinking, well, we're pretty much at the top of its range. We don't think realistically it's going to go up that much further. Therefore, we need to start looking at the technicals to say, yeah, we think the game might be up, and we think we need to sell. What we do on the selling is we tend to use the 50. We use the 20 in micron, but the 50, this green line, is the one that we really focus on. And you can see here that we see all the time the stock is above the 50, we consider it to be in an uptrend. It broke the 50 here, and we now consider it to be in a downtrend. So those are the points that we use to say, do we sell or not? And here you can see that it broke its 50-day here. It's very close to this support point, so we would have probably waited to see whether this held or not, and we may well have got shaken out around here because it didn't look like it was doing anything. The stock carried on going through and was looking to move to this next point. We would have probably come out of it around here, I reckon, and then it went up, but it went sideways. If we look very quickly at Rheinmetall, um, we got quite a few questions. We had Rheinmetall as our biggest winner last year, and we had it from middle of February, something like that, all the way up to, I think it was July. Well, it might have been August. No, it was around here. It was at the end of July. So we had this whole ride from somewhere around here up to here, and the stock doubled. I seem to remember. So, and we came out of it when the 50-day was meaningfully broken. And you can see here, we were being asked questions all the way here saying, well, it's starting to go up again. Why aren't we in it? Why did we sell it in the first place? But actually, it's done nothing. It's just gone sideways through that. And that's what we see a lot of the time. We see these big rises, and then the market has to digest the fact it's risen so much, and it just goes sideways for our Nvidia is another good example of that.
See, the thing is that one of the things that we talk about internally is, of course, those stop loss things that we want to. I won't say keep our profit. We can't always keep all of it, but at one point we, of course, take a decision. But one thing that I will say, never do is put in a stop loss in our portfolio so it sells per automatic. We always do it, shall I say, handheld.
Yes, yeah, we do. There are a few reasons for that. We've seen quite a few examples in the last year of fat fingers from traders and also IT problems where the opening price or a price has suddenly dropped below quite significantly where it should be, and then goes straight back up again. And that would trigger your stop. So we don't like that. We want the control over that. Um, we also want to look at the news when something comes in. So triggering a stop loss automatically when we look at some news and think, well, actually, it's not as bad, and we think the market will probably come back. So if you look, we'll keep it on this. If you look at some of the candles here, you can see this sort of candle where let's just zoom in a little bit, where actually the pinhead is right at is pretty much at the top, and you've got a longer tail at the bottom. I'm trying to see whether we've got a better option here. That tends to show that actually that sort of action means that the sellers tried to sell and then the buyers came in and supported the stock going up to the top. So that tends to be a good indication. So we wouldn't necessarily want to sell in this gap. We'd actually want to wait and just see what the price action did. So that's another reason why we don't set stops. The third reason is we've done quite a lot of research. So we also run for a number of automated strategies and algorithmic based strategies on the system. And they've been doing pretty well to all intents and purposes. You can see sort of the US ones are up 40%, 40%, 40%, 16%. That's over a couple of years. So they're averaging pretty well. Um, with these strategies, we did a lot of research on stops, and the best fixed stop we could, or the percentage stop that we could put in was 45% below the opening price. That was the only time over a 20-year period when we back tested this stuff that the stop loss actually helped us and reduced our losses. And a 45% stop is psychologically virtually impossible to handle.
Yeah, because then you have to stomach a lot on the way down towards that.
Exactly,
Yeah.
exactly. So we find our approach of saying, okay, the 50-day, if it's broken, or the 200-day, or the 20-day in some cases, if that's broken, we'll come out. And actually, if we're wrong and it pops back up again, it's a great stop. We'll just go straight back into it, and we might have lost 5-6%, but there's going to be 50% upside. So
See, now we have a very interesting question coming in from Ole, who sent us a mail at fomo@mystockscanner.com. And thank you for all your questions. We won't get to all of them. We promise we'll keep this at 60 minutes. But as said in the beginning of the show, we're going to do this every month. That's what we're going to do in the future. That's what we do for you guys. We'll do a Q&A every month. So we will get to your questions over time. But Ole wrote us and said, I'm considering selling Glencore because of the merger with Rio Tinto went through, and he had it in his portfolio. He says, since the merger is not going to happen, should he get out of it? Again, we don't give specific stock advice. We will take a look at both Rio and Glencore and see what our thoughts are. Liam,
Yeah.
we're in your neck of the woods. We're in Britain right now.
Yeah, it's nice to be home, to be honest, away from all that foreign food. We can say, oh, this is Glencore to kick off with. Immediately, you can see quite a lot of red. The quality score is 45. That's pretty much because of this mess here, where Glencore sort of lost money, made money in these years, lost money, and so on. It looks like it's onto a good thing for this is we still haven't had last year's results in yet, and next year. And the peg ratio, because it was a loss last year, we don't know what the peg ratio is, so we haven't got that piece of information. But what we have got is some red on here, so the returns on capital, returns on equity aren't great, they're red. Free cash flow is okay, but it's not going in the right direction. It's been dropping for the last 3 years, so that's not good, and it's very expensive compared to the cash that it does actually generate. Sometimes the current ratio doesn't give you a good idea. In capital intensive companies like airlines and some mining companies, the current ratio, yeah, the assets and liabilities skewed a bit. So interest coverage also, though, isn't particularly good. So that's something I'd look at and worry a bit about and do some research. Doesn't mean we wouldn't go into it. It just means I'd like to understand why those two figures are quite low. And, this one's in the red and this one's almost in the red. It could well be the way they deliver their or make their derivative contracts, which the Glencore was really started. I remember when they listed, but I can't remember. It was 20 years ago, something like that. They were started by derivatives traders to take advantage of the network that they had. um, so maybe it's the way they're financing things. So immediately I look at that and think, actually, I don't like it, and it's something I'd be nervous. It's not to me a quality company, even though I know they do make money. On here, they're actually not too bad on the value chart, but the value chart, because it's up and down so much, it actually makes it incredibly difficult to map out because I pretty much had to go back to 2017, 2018 to really base the bottoms and the tops here. So if that's right, and we can work on 7-year-old figures, then there could be a 6% upside in the worst case and a 41% upside in the best case. But it's not a pretty picture. So it's something that personally I would stay away from until they start getting some solid earnings coming in. If we just switch to Rio very quickly, slightly different picture. It's green because the company's sort of increasing the amount of money it makes. Quality score is 81 because the earnings have been pretty much solid going through. They're not stellar. They're not as pretty as some of the charts we've seen so far. The returns are in the red, not great, but they're not dire. They're pretty much on average. But because of this outlier here, that in 2021 for the returns, then I think everything else is just being pushed into the red because they're just not improving on that, and they haven't got an issue with debt out there, so interest coverage. So that's fine. But because of that, I would suggest that maybe the company is fairly well priced, if not overpriced. So we can see if I just move these around to actually, I'm just going to match the base case to where the analysts think it's going to be, which is about break even. And maybe just match the green on where it's been in the past. Here you can see it matches these peaks coming up, pretty much matches that. You might have a 13% increase in the best case scenario, but we could lose 33%. And these are the odds that I'm talking about. I'm not going to risk 33% drop just to make 12%. I want it the other way around.
Let me throw a curveball in there just to ruin your nice picture. We're talking a mining stock. It's everywhere, Liam. We're talking rare earth, we're talking copper, we're talking gold, we're talking cobalt, we're talking anything. They are sort of the trend right now. Doesn't that change the picture for these things, those numbers?
It doesn't change the picture from the playbook point of view and our strategy. We're just, and it can be as great as good as it wants. Once it comes down into this level, I'll be looking to buy it. While it's all the time it's up there we've literally got hundreds of companies that we can put our money into with a better risk reward ratio. and
And
that's what
that's
it's
the
about.
thing. How many stocks are in our mystockscanner.com? Are we talking 80,000
We've
stocks, or
got
what are we
70,
talking?
80,000, something like that.
Yeah.
Yeah,
So there's plenty of stocks to look at, but there's always this, and that's why we call it FOMO, fear of
yeah.
missing out. That's also our email for the show. And the thing is that people, they feel it all the time. We even feel it once in a while. We go, oh, we should be in more mining stocks.
It is, and that's I talked earlier on about the stop map functions that we're developing. That actually tells us what sectors, what industries, and what stocks are moving at any one time in combination with each other. So it's a really interesting sort of tool that we're building. So, yeah, but at the end of the day, when we look at our playbook, which is everyone can see the summary details on here on our performance and the monthly performance and things like that. What you won't be able to see is positions if you're not a paying subscriber. Um, but what you can see here is basically we rotate around the sectors based on what stocks are coming around at any one time. So we started rotating out of tech about 3 months ago, which is pretty much on the dot when all the jitters started coming on. So they were there beforehand as well, but it was when sort of the real jitters started coming and the big drops and the big volatility in the market. The playbook actually took us out of that initially because we saw the drops. They dropped below our certain thresholds, which is our 50-day moving average generally. We came out of them. We're not being impacted by them, and we moved into industrials, healthcare, consumer defensive, and to a lesser extent, consumer cyclical. So we moved into more sort of boring stocks that make money and people shelter in.
Yeah, and the thing is that we're not married to our stocks. We don't have a feeling towards what it is, so we don't like a specific company or stuff like that. We simply stick to the numbers. We simply stick
Yeah,
to the strategy that we have. But I know one thing that you dislike, Liam, and I'm going to bring it
and
up. No, no, not at all. But I'm
no,
going to
I
bring it up. I'm going to bring up some pharma for you because I
oh
know
yeah.
that you really do not like pharma in that sense. And you get to explain yourself in a minute. But Live sent us an email that he came across Tiva Pharma Industries and um, explain why don't you like pharma? What's about it?
It's not that I don't like pharma. We're in what, three pharma companies within the playbook at the moment. I seem to remember, but they are more mainstream companies. When you look at the pharma industry, you get a lot of smaller companies that have profiles like this. We can see it, and Tiva is a perfect one. And when we were talking about it earlier on, I was saying actually this is a really good example. It's a really good example of why I don't like it. Um, you can see here they made a bit of profit in 2021. That could have been luck. I've got no idea. And then they made losses 3 years after that, and then this year they made a profit, or last year, and then they're saying actually things are really going to accelerate. If I looked at 200 similar pharma stocks, all of the analysts would be saying exactly the same thing. The picture is rosy. Everyone's going to make money that invests in this. And that's what I don't like about the pharma stocks. The analysts that cover them tend to be even more gung ho about sort of putting high PE ratios and high earnings futures into them because they believe the hype coming out. And a lot of the time it is hype because a lot of the time these companies have experimental products, or they've got an existing load of products and they've got a few that are just about to come out and are being in trial at the moment. You only need one bad trial result and the company value gets halved sometimes, and we've seen it again and again and again. And you got Genmab, you got Zealand Pharma, and over in Denmark. They're really good examples of stocks that have had great sort of earning potential. The analysts have loved them, the investors have loved them, and then they've dropped off a cliff because something hasn't quite gone their way and everything hasn't lined up. So for me, pharma stocks have to be, have to have that perfect execution all the time to actually get the big bucks coming through. Whereas the other more boring stocks that we look at, they just have to pretty much get along and do what they say they're going to do, and they make money, and they make money for us.
Let's take a look at Tiva just for
Yep.
the case of life here. He
Yeah.
really hopes to get clarified a little bit about one thing is the analysis, the personal opinion he didn't ask for. I will say that, but he got that for free.
Yeah, it is. It's just a warning, really. So when
Yeah.
you look at these stocks, just bear in mind that everyone says they're going to be brilliant. So that's all I'll say. I'll shut up about that after now. The quality is great. Earnings looking to go up if you believe them. No, I'll stop now. Peg ratio is great as well. So yeah, we're basically saying there is more upside in the price. So I expect when we hit the valuations tab on here that we're going to see sort of quite a good valuation perspective coming in. The returns are great. Companies making free cash, and that's one of the things I look at in pharma companies when I do get dragged kicking and screaming into examining them, whether they're actually making some cash or not, because actually that's another big red flag. If they're not making cash, it means that actually they're a poor investment for us, we think. So that's good. Also, the current ratio, because of, depending on the setup, if they've got big laboratories, then often you find the current ratio is slightly skewed. But the interest coverage is pretty healthy at 2.3, so it can cover its interest, either the debt that it's got with its earnings. So that's not a problem. So yeah, okay, tick in the box for that. And we can see here, it's got potential. You can say that. However, where the hell do you draw this chart? We haven't got anything going back apart from back 10 years ago, a little oasis here where sort of it just pushed its head above water on the earnings side of things, and last year it made some money. But basically, without that comfort blanket of us knowing how investors have priced this in the past, what the tops where they've been willing to pay, and then stop paying and selling are, and where the bottoms are, it's very difficult to actually say that the value chart is right, because actually, the green line could actually be up here and the blue line could be up here. You could argue that as well, because we just haven't got the history to go in there. So that's again a reason why I don't particularly like these sort of stocks. I would far rather see something where we've got some solid history. We can see where the investor's gone in and out, and that gives us a really good comfort that actually the numbers we put in here are correct.
And again, we see the sea of white in that sense that there's no numbers, there's no income, there's no nothing to measure on, and that's
Yeah.
what your big take is on this. In that sense, just for argument's sake, let's put it up in the timing wise. Is there any timing to be found at all in a stock
Yeah.
like this?
It's been in a great uptrend since August. So yeah, you never know. I could be absolutely completely wrong. And the stocks will go up. Stocks go up. Stocks go down. And that's not the point. What we're trying to do with the first 2 points of the question, on the playbook, is to say put ourselves in a position where actually, if the worst happens, we don't get hit as much. So here, investors believe it. They're coming in and buying in droves because they believe that everything's happening. I haven't done any research on Teva. They may have had a particular breakthrough. They may have had a product that's gone through phase 3 trials in the US or something like that. So I've got no idea, but that could be driving the stock. But as I say, and I've come back to a number of times, there are literally hundreds and thousands of stocks that we could put our money into that give us a bit more comfort and on getting return than a company like Teva at the moment. So why wouldn't we park our money in that?
And that is the question that we ask each and every day is that are we looking at a stock with an upside? Are we looking at a quality stock? And are we looking at the right timing? You could say some of it was fulfilled here in Tiva for our friend who asked about it because life got into it. And if he's taking that right, good for him. And we don't envy anybody who makes that kind of
No,
money. We are interested in the tool. And that's what you guys have created, Hans-Henrik, and you have created the 3 point playbook and the tools for it. Basically, it's up to you to make the money out there, you guys who write us each
it
and
is.
every day.
The important thing to stress in here is that we push the playbook, and that's it's a movable target. We say based on a risk tolerance, these are the sort of things that we look at, and we know our risk tolerance. We know most people's risk tolerance. We've got investors, we've got loads of investors that actually push the boat out and actually take more risk on board and get more return, but they also get more of a dive, they get more of a drawdown in their investing, but they're happy with that. So it's important to note that it's not necessarily right or wrong to go into Tiva now. It's just not right for the approach that Hans and I take and you take in this. Um, and but what we try and plot, what we try and teach people is understand your risk parameters, understand what type of risk you want to take, and then form your strategy around that. And if you don't use the playbook and you want to use some other way, this isn't rocket science. You're basically, the playbook is only a way of identifying quality stocks that are cheap, that are about to go up. If you've got another way of doing exactly the same thing and another process, then absolutely great. The tools are still there for you to use.
And that's what we put out there each and every day. We do our daily show in Danish at noon on Mondays to Friday. Liam is with us on Tuesdays and Thursdays. And apart from that, you also write the articles on the tech side and keep us updated there. That's also part of the benefit of being a member of My Stock Scanner, is that you get Liam's take on tech. You get the market scan each and every morning before 9 o'clock. Hans-Henrik works away almost at nighttime with a mining lamp on and get a look at what goes on in the macro side. And then he does the weekend wrap on Sundays as well. We're basically always there for you. We try to take your questions just like we did tonight. And as said, we're going to do this once a month. We're going to take your questions first in English. Tomorrow, we're going to do it in Danish. We're going to do that at 7 o'clock tomorrow night, when Hans-Henrik is up and ready. And as said, a full hour tomorrow with questions. Some of them will be repetitive from today because, of course, we're going to do them in Danish. And as said, um, every day at noon, that's when we're there. We are just happy that you're with us. We're happy for the questions that you give us. It's also a learning moment for us every time you get a question. Isn't that true, Liam?
Yeah, completely. And we've got some reviews recently from a lot of our users, so that we can put them on our new website. And actually, the amount of times that risk management was mentioned, which I didn't think it would be, is a great thing, because that's exactly what we're trying to teach: is say to people, identify what your risk is, identify what the trade risk is, and what the downside and what the upside is. So that was music to my ears to see that, and I didn't expect it. And some of the questions coming out tonight, some of the companies were interesting ones that I'd not really looked at before.
That's how we play ball with you guys. You play a ball to us, we play it back to you, and that's how it goes back and forth. 34.48%, that was the result for 2025. So far this year, we're up 5%. Of course, we keep count and we keep trading. Check us out tomorrow. We'll be back at noon tomorrow in Danish and the webinar tomorrow night. Liam, thanks for being here tonight,
Thank
and
you
we'll
very
see you
much.
guys in a month's time, and we'll be back.